All right, welcome back to Lunch of the Market. Today we're looking at the Coinstar/Amazon.com rumor that there will be a partnership between the two to take on Netflix. Valuations on Coinstar are a bit stretched on trailing earnings, but the forward PE isn't true. It's about 15.12 on forward times earnings with a peg of only 0.84. If there's a deal with Amazon and Coinstar, that really isn't factored into the EPS numbers for Coinstar, and any potential deal for the two companies could be a multiple expander for Coinstar, right? So meaning you could see it trade with a 20 multiple and a higher EPS number, right? So obviously that would put the shares dramatically higher. So what do? We did a call spread risk reversal on Coinstar out to January of 2012. What does the structure look like? Long 40-50 call spread in Coinstar, and then we're short a 35 put against it, right? So 35 would be quite a bit lower, better than 10% down from where it's at right now, and then a 40-50 call spread. To do this, we paid 90 cents for the structure, right? So our max upside is the $1,000 between the 40 and the 50 calls, and we only paid 90 cents. So that's our risk, right? We risk 90 cents to make, I guess you could say 90 cents to make $10. We risk $90 to make $1,000. Pretty good risk reward. If Coinstar does fall to 35, the valuation would be even more attractive. And you know, Redbox has been innovative. Between Netflix and Redbox, they basically got rid of Blockbuster, Hollywood Movie, basically every movie store you could possibly imagine, right? It's either Netflix or Redbox. They're, except for a few very small chains of video stores, and depends on what kind of metro area or non-metro area you're in. Those are really the only two ways to view content beyond, you know, digitally downloading it, accessing it on iTunes, things like that. So that's where we're at. It's at the January 2012. It's a 35, 40, 50 call spread risk reversal, where the 40, 50 is our long call spread and the short 35 put, right? That's where you get the risk reversal. Okay, next, at NC Lobo asked for PBR. Honestly, we've talked about them on July 20th in 2010, and then again September 2nd in 2010, and really not a whole lot has changed since we gave it the thumbs up back then. The stock doesn't pay a meaningful dividend. Honestly, there are better places to play in the energy sector. Although the stock was in a nasty downtrend from about May of 2010 until January, until right around January, late December, early January. It broke out of that and then had a successful retest and held on January 27th. So technically it's trading extremely well. The next level of resistance for PBR is about 38.71, and then above that there's a $42 level it's got to get through. But look, if you're looking for momentum in the energy names, why not try Repsol, REP? It's at 52-week highs with a 3.6% dividend, and Total, symbol TOT, which is at a 52-week high, but with a 4.7% dividend and a single-digit PE. Both of these names are off the radars for most traders. They have extremely attractive valuations, and they've lagged the performance of U.S. integrated names like Marathon and Chevron and Exxon. Speaking of Chevron, we continue to think that that stock is an extremely attractive valuation. We are already long and have been long since about 70, and it trades at 11.5 times trailing earnings with a 3.1% dividend. So really any of those, Repsol, Total, Chevron, are all extremely attractive. They're really better in breed than PBR, Petrobras. So, you know, you may want to look at swapping out of PBR or avoiding getting in and taking a look at Total, Repsol, or Chevron. All of those pay a dividend. They'll pay you to wait. They haven't been terribly volatile, but obviously the energy space doesn't go up in a straight line. And, you know, if you get extreme enough volatility, you can sell put spreads to hedge your long position, right? Stock drops, you sell put spreads against it, wait for it to recover. You can put on you should be able to put on a no-cost collar or a very low-cost collar. So if you're long the stock, you sell a call above it and then use the proceeds to buy a put below it. You should be able to hedge relatively easy because of the low volatility in a lot of these integrated names. Okay, thank you to Deckers, which broke back above $75 level and held with only 13 trading days left until options expiration. We're going to continue to hold those short 75-70 put spreads into February 18th. There's really no issues on our screen at all today. We did, on the one red name, add to the February 195, 190 put spreads in Netflix. We had somebody who mentioned us on Twitter and said, Hedge Fund Play said that Netflix was cheap. I don't know that it's cheap, but it's certainly a stock that it's held up extremely well. It got through the earnings gauntlet and has traded extremely well. So it's probably going to be our last trade until we get to the week of options expiration, and then we'll look for any gimmies, meaning $10, $20 out of the money put spreads that we can sell for, say, 50, 60 cents, right? Especially if we can find like $2 and $3 spreads that you can take in that much credit. Okay, finally we did a 45, 41, 37 put tree on Broadcom, right? So we're basically long a 45-41 put spread on BRCM, and then short a 41-37 put spread on BRCM. They report today after the close. John Najarian highlighted negative or bearish trading in the options for BRCM, and so we wanted to have a trade on. It's actually worked out well for us. We did it in Amazon. It worked well because the stock went down. We did it in Netflix, and it worked because the stock went up, because we go in there and layer puts at the appropriate place to make the trade profitable. Okay, those 160, 155 short put spreads that we added to our Amazon put tree after we took off the bearish top half of the tree. Amazon is trading up $2.64 today. It's above a 172. It really held that 170 level very nicely. It did trade below that level, but then by the end of the session, it's really fighting with that 170 level. So we're pretty good on both of those. And then again, obviously, with Netflix trading at $213 a share, those 185s are pretty far out of the money. So we like that as well. Another stock trend, whatever, that we saw off of Fast Money that really, speaking of Broadcom and Qualcomm, both now are on our short list to be acquired in terms of, we want to increase our positions in those names. We have owned Qualcomm in the past. We have not owned Broadcom, but we want to add both of those back to our portfolio, because the reality is that Intel really made a bad bet on where they felt like mobile computing was going. Check out all the details on the failure of the netbook, and I think ultimately, at least for now, Intel's business strategy on the blog. You can find the blog by going to magnumopusfinancial.com. Scroll down a little bit and look for the MOF News Network. Click on the MOF blog, or just go to our Facebook page. Right, look on Facebook for. You can just search Magnum Opus Financial. You'll pull up our Facebook page, and we've put a link right to the article right there on the Facebook page. So however you like to get your content, there's two ways to do it. Check out the full article on Intel and why I think that's a sell, and really Broadcom, Qualcomm, and Apple are all a buy. All right, thanks for joining us again today. Don't forget, America's Favorite Traders kicks off this afternoon at 6 o'clock. You won't be able to hear it live when we do the first episode, but we'll have it up as quickly as we can. Certainly our goal is to get it by the end of the week. Remember, you can download all of those free on iTunes, and we'll also have a link right on the webpage to get to the latest episode of America's Favorite Traders. All right, thanks for joining us again today. Have a great day, and we will see you tomorrow.